Hey everyone. Ford has had a wild year, especially the stock price, right? Ford's stock was up almost 35% in the middle of the year. And then now, as of this recording, Ford's stock price is down 4% on the year. So in this video, I'm going to look at Ford. I'm going to look at its prospects for next year, and I'm going to look at its history. I'm going to answer if I think Ford stock is a buy for 2024, looking at its profitability, its valuation, and the prospects for the car market overall in 2024. So let's jump right into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
I mentioned earlier the wild year that Ford stock has had. You can see starting the year here, it jumped all the way up close to being up 35%, and now it's down 4% after being down nearly 20% for the year. So a volatile year for Ford, which is typically not a very volatile stock. Interestingly, this year has been volatile for Ford. So one of the reasons why investors are attracted to Ford stock is because of its phenomenal revenue. And you could see in the trailing 12-month, Ford delivered 174 billion in revenue, a massive scale for a car manufacturer and seller. And you can see it has grown nicely from a little under 150 billion in 2014, following the big crash during the pandemic when supply chain shortages really limited sales for a moment. But that's since recovered, and Ford is doing very nicely in the trailing 12 months. And I suspect over the next 12 months, it will also be a strong year for sales for Ford, especially in the internal combustion engine side. Right? It's rolling out electric vehicles, and that side of the business is growing, but it's not profitable. But the internal combustion engine side of the business has done really well. The supply chain shortages allowed Ford and other manufacturers to focus on the most profitable models and the highest selling price models. And that's allowed them to sell those models because customers don't have the choice to buy those cheaper models. Manufacturers are not creating those cheaper models as much as they used to before, prior to the outbreak. And so this confluence of factors has worked in Ford's favor. And still, when you look at dealerships, when you go out to look at cars, the availability of internal combustion engine vehicles is not as robust as it was 2019. And they're taking much shorter times to sell, especially compared to electric vehicles, which an article came out in the Wall Street Journal a couple of days ago highlighting the big difference between the time for sale. It takes much longer for dealerships to sell an electric vehicle than it's taking for an internal combustion engine vehicle, as consumers are doubling down and really telling manufacturers that no, we really like these internal combustion engine cars. More than 9 out of 10 consumers are choosing an internal combustion engine. And if you exclude California, that number will probably be more than 19 out of 20, right? California is the largest EV market. It's kind of unique in that it's got very high demand for electric vehicles, where if you exclude California, that number will be much smaller for demand for electric vehicles. Another reason why I think investors are attracted to Ford stock is because of the robust dividend yield. Ford offers investors a dividend yield of 5.38%, a relatively strong dividend yield when you compare with other dividend stocks. And compared to the government bond, it's also a strong yield, right? A government bond, you can get a 2-year government bond paying around 5%. You can get a 20-year government bond paying around 4.7%. And so depending on your risk tolerance, you can choose the government bond, which has very limited risk. Ford stock offers you the dividend yield of 5.38%, but something you get with Ford stock that you don't get with the government bond is a chance for capital appreciation. Ford's stock price can increase, thereby giving you an additional source of return on top of the dividend yield. I mentioned earlier that Ford generated $174 billion in revenue. That has demonstrated, that has proved, and the company has reached large economies in scale. Economies in scale is one of the most desirable characteristics you can find in an investment. In the example I have created here, sales grow from 100 in year 1 to $115.76 in year 4, while net income more than doubles from $4.50 to $9.47 in year 4. This company demonstrates economies in scale. As its revenue grows, its profits grow by a larger magnitude. Not every company can achieve this kind of effective growth. Here's how it works. This is a typical categorization of an income statement of a publicly traded company. Cost of goods sold is what's called a variable expense. That means cost of goods sold is connected to sales. Other expenses like interest, general and admin, and depreciation are not connected to sales. You can see here depreciation stays the same at 25 whether sales increase or not. The same is true for interest expense. It stays the same whether sales grows or not. You can understand your interest payments do not increase when your sales increase. Overall, businesses typically have a mixture of fixed expenses that are unrelated to sales and variable expenses that are. When sales increase, the business leverages those fixed expenses, as we see in this example, and profits grow by a larger magnitude than the increase in sales. And so the actual number here, if we look at Ford's operating profit margin, you can see it's held steady. I shouldn't say held steady, but it's 8% in the most recent trailing 12 months, which is right where it was around 2014 after fluctuating wildly over the last decade. And that's something you should keep in mind with Ford stock. Ford itself is a cyclical company. What that means is that Ford will do well when the economy does well. When people are getting jobs, when people are getting raises, when people's prospects are looking good, they will go out and they will buy new cars. But when people expect to maybe lose their job or maybe get a pay cut, they're not going to go out and buy a new car. Especially if people lose their jobs and there's mass job cuts in the economy, then buying a car is not something that people do. And so it's an up and down business with the cycle, with the economic cycle. And that's the nature of Ford's business, which makes it more risky. The good thing is that Ford has generated strong cash flow from operations in the last decade over the trailing 12-month period. If you look back, regardless of what time period you look, Ford has generated at the least a little under $8 billion in trailing 12-month cash flow from operations. And at the peak, it was generating nearly $30 billion in cash flow from operations in a trailing 12-month period. So the company generates strong cash flow. It's a profitable business. I've already showed you the operating profit margin, but the cash flow is even stronger than operating profit because it excludes some of those non-cash expenses like depreciation. And the company does have a lot of property, plant, and equipment that depreciates, but it's a non-cash expense. Ford has already spent the billions of dollars building out its manufacturing facilities. And so for that reason, its cash flow from operations will always look stronger than its profitability. I shouldn't say always, but in most cases, it will look stronger than operating profitability. So one thing that is a bit of a concern for Ford stock investors is the massive debt load of $142 billion. Of course, this is partly due to the financing arm of the business that finances vehicle sales. And then if you look at its cash, it's got $41 billion in cash and short-term investments and another $57 billion in accounts receivable. For Ford, this accounts receivable is pretty likely to be received because this is accounts receivable based on cars, right? They've sent dealerships cars and they owe Ford money. And if they don't get that money, they can always go and repossess the cars. So with Ford, I'm not concerned about accounts receivable as much as I would be with other companies because they have those physical assets that they can go and recover should the companies not get repaid or should one of the larger dealership partners not pay them. They can always go back and repossess those vehicles. And finally, I wanted to look at valuation. Ford here is trading at a forward price to earnings of 6.186. That's a lot more expensive than GM at 4.42 and Stellantis at 3.996. Still, a valuation of forward PE of 6.186 is relatively cheap. The average stock in the S&P 500 is trading at a forward PE of between 16 and 20. So Ford is about 1/3 the valuation of an average stock in the S&P 500. And given that its prospects for next year still look strong, those factors that led Ford to generate strong sales and profitability in 2022 and 2023, I think are going to continue for the most part of 2024. Supplies for internal combustion engine vehicles are still not going to be back to 2019 levels. And so it's still going to benefit from that limited supply in that area. The electric vehicle side of the business will continue to struggle. Sales will increase, but profitability will be a challenge. And so that side of the business is not going to contribute meaningfully to profitability. But the rest of the business, I think, is going to be so strong to justify an investment in Ford. So to answer the question, is Ford stock a buy for 2024? I would say yes. I would say yes. Investors can feel reasonably good about investing in Ford stock at these valuations. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.